Greetings, Webinoids. Dr. K coming at you from London and Gil Morales from Playa del Rey. And in top of the news today is more issues out of Cyprus with the ECB giving them a deadline um, where they will end the lifeline to Cyprus if they don't come to a rescue agreement by Monday. But our feeling has been, with these crisis situations, they tend to come and go, and we've had quite a few of them since 2009. And you'll see on the charts, the overall general markets tend to find their footing and then move higher because we are in a QE environment, and all the central banks out there are firing off QE like money's going out of style. So I think that this crisis will blow over like the others have, and you can even see that despite Cyprus, you'll see in the major indices like the Nasdaq and the S&P that they recently hit new highs. So I think that tells us a lot that the big money out there isn't taking this crisis that seriously. And you can also look at if you look at the IEV, that's the iShares S&P Europe. It's a basket of European bourses. That's not faring too badly either. And then the EWU, that's the British one, that's kind of a mirror image of the IEV. So that's they're hanging in there pretty well. And ultimately, though, if things do get worse, we'll see it show up in the price volume action. If things are going to be different this time, but based on history, probably not. So the market continues to baby step higher as QE pushes it higher on these QE fumes. And meanwhile, we're seeing precious metals such as GLD having got support the last few weeks, and it's in no man's land right now. It's in the middle of its facing pattern. It's under resistance at the 50-day, and there's also the 200-day it has to get through. But it does get support, it seems, when it heads and retests the lows of this very long base that started back in September of 2011. So our view is that precious metals are still have a lot of tailwinds, and therefore this base will at some point complete, and we'll be off to the races again. But it could be a number of months before that happens. And of course, if gold were to break below the lows of the base, that'll be the first time that's happened in 12 years of this very long rally in gold. So that would certainly be a big cause for concern on a technical basis. But we're not there yet, so we're just going to continue watching. Gil?
Yeah, I was just thinking about this whole Cyprus thing. And I know, you watch the news and everybody's pretty sanguine about it. Oh, it's just a little country and blah, blah, blah. And it does seem like the market isn't taking it all that seriously. But I try to look at what does the crowd know, and the crowd seems to know that, yeah, it's not a big deal, and it won't turn into anything. But I'm just wondering, the EU is taking a hard line against Cyprus, and what happens if they can't work something out here and the banking system in Cyprus fails? And Cyprus supposedly is a small, a little speck on the map here. And if the EU can't deal with the crisis in Cyprus, what happens if countries like Spain or Portugal or Italy or maybe even France go the same way? What does that mean for the EU? Do you think, Dr. K?
Well, certainly they don't want a domino effect to occur, so they're going to do everything to avoid that. And I think their solution has been and will continue to be to print money, because you throw money at the problem that seems to plug up the leak. And it reminded me of the little Dutch boy who saved Holland by plugging up the dike with his fingers. But if he were in this situation, he might find himself running out of fingers.
Yeah, exactly. And then what happens is he's got his finger in the dike, and the water behind the dike is getting higher and higher as they just continue to print more and more money. And I'm wondering exactly how do you pull your finger out of the dike in a manner that doesn't create some sort of a flood, or does eventually your finger's in the dike, but it doesn't prevent cracks from showing up, and eventually the whole thing just collapses of its own weight. Listening to Bernanke yesterday talk, he doesn't really exude a lot of confidence to me. The guy, his voice quivers and shakes when he speaks, and he's a lot of uhs and just talking in sort of academic gibberish to me about what happens when you do this and increase the monetary supply and all this other stuff. And he assures us that he has the tools to execute an orderly exit or a soft landing, so to speak. And you just have to wonder when this whole thing comes unraveled. And the one thing I find unnerving, and maybe you can speak to this a little bit, Dr. K, and soothe my nerves, is that you're going to wake up one morning and things are just going to be collapsing. There's not going to be some warning. You're not going to have some price volume warning where things start to weaken, or will you? I mean, what is the risk here, and how would investors either hedge or account for this sort of thing? Because I've had some emails from people telling me, I cannot sleep at night if I'm long, no matter what, even if I have profits, because I have these nightmares that you're gonna wake up in the morning, everything's gonna be collapsing. And my answer is always, well, if that's happening, you got bigger problems than your stocks going down. But what's your thoughts on that? And how should investors, if psychologically they find themselves impaired by what's going on, and it does at times look a little bit freaky and scary, how would you deal with this and still be able to invest in the markets?
As I've said on CNBC and some of the other interviews, well, I'll just make a prediction, and I have basically framed it in the form of a prediction, that it won't matter if the little Dutch boy has 100 fingers, because the dam's going to start to overflow from all the money printing that's going on. And so I hope that creates an interesting image in people's minds. But yeah, there could be a big, big price to pay. Who knows? 2 years, 3 years, 5 years down the line from all the money printing that's been going on in Europe, UK, and the US.
So as an investor, if the market keeps trending higher, would you just continue to plow into the market and adding to positions to the point where you're 200% on margin, and just continue that way, or would you be a little bit more active, seeking to perhaps short-term or swing trade some of these moves? Because I notice a lot of stocks will run up and then they'll blow up, or they come back in pretty hard, and so it's difficult to make overall progress on a trending basis. But you can make 5, 10, 15% here and there and bag that and then wait for another buy point. Do you think that's a prudent strategy if one is psychologically impaired again by what they believe is hiding in the closet?
Yeah, I think that price volume always rules all. So we had in the late 90s a huge bull market, but at the same time it was climbing that wall of worry with Greenspan saying that everything's irrationally exuberant right now, and the markets would sell off hard. And even into the market top, end of 99 into the first quarter of 2000, I remember the market would move ahead very quickly, and then it would also yank back in a very volatile manner. So I found that I had no choice but I put the full margin accelerator on, 200% long, and then back off very quickly, and all the way down to maybe 30% long. And that was the rhythm of the market at that time. That's what price volume dictated. This kind of rhythm is different because we're not seeing huge forceful upside moves, and therefore I'm using price volume action again as my guide. I think that doing swing trades we are more in the swing trade environment, a more short-term environment for stocks. It's very rare you can buy a stock and just sit on the stock for months, and so therefore I'm using price volume as my guide. And I do like spreading the risk around between, you could have some stocks maybe in a long side, you see some stocks a short as well, and then you have your ETFs. And a balanced approach seems to work for my trading personality right now, because I don't see a whole lot of opportunity in anything. But also in these challenging environments, we don't want to get nickeled and dimed and quartered. So I want to keep my losses risk to a minimum.
Right, and I would say my own experience in my own personal account, I'm up for the year a decent amount, but in our managed accounts and in our fund, where we try to ride a little bit slower and ride a trend, it's been very difficult, and at times we just get nicked and dinged to death, and we'll have a stock work here and then another stock blow up over here, and so it's very difficult to make net progress if you're operating on a slower time frame and trying to pick out and ride the trend. So it's almost like you're getting a lot of static interference in the wave, so to speak, and it's hard to ride the wave. So it reminds me of trying to ride waves, on a stormy day where you might get some swell coming in, but there's so much chop because of the storm that it's hard to actually get a nice even ride on the wave. And some of you surfers might know what I'm talking about. So I can remember some stormy days like that. Pardon me?
Trading is surfing. It's a great
Yeah,
analogy.
it is, and so it reminds me of that. But what I do then is I get out my boogie board instead of my surfboard and just try to slash around on the waves and make some progress and have some fun. But anyways, I'm just going to go through what I'm seeing in the market. I'm counting 3 distribution days on the S&P and the Nasdaq. Dr. K, what is the model looking at in terms of the number of distribution days currently?
Well, as we know that with QE at the helm, it looks at distribution days, but it doesn't necessarily trigger a sell signal just because we have a cluster of them. It's really accounting for QE and what the market has been doing in this renewed QE3 environment. So it's basing its signals more on, I mean, it's obviously taking price volume into account for leading stocks and major averages. But in terms of distribution days, you can get some false signals in this kind of environment. And that's happened last year a few times where the model, the market would band just wide enough to trigger the model's buy then sell signals. So it's learned from that experience, and certainly these choppy, sloppy types of market movements could reoccur in this kind of QE motivated environment. And we're already seeing the type of uptrend we get. It takes the market 20 days to achieve a certain profit, and then maybe 1 or 2 days for that profit to be completely wiped out. So that's the kind of environment we're in.
Yeah. Let me just go through some of the things I'm looking at. You guys know, we've been looking at the gold and GLD. That is technically a pocket pivot, but you're not coming off the 10-day. You're actually coming off of a point above the 20-day, which is actually a 20-day exponential here that I'm showing on this daily chart. And you're really in this range here, so you're at the top of the range. I know somebody emailed us to tell us, I've shorted here. It's at the top of the range. I guess if you believe that everything stays in a range forever, using that argument, you would have gone long the GLD right here. So it broke out of this range and went lower. I think what you do is you wait and see if the thing comes up to the 50-day moving average and starts to break this downtrend. If you look at it on a weekly chart, it's really pretty well stuck in this downtrend, and until that breaks, I don't really think you can say that you're in an uptrend. I do think, however, that if the crisis in Cyprus continues to expand and it becomes a domino that falls and sets off some other dominoes, and everybody scrambles to take their money out of the banks, and there's a run on the banks, and everybody moves into precious metals, I think you will see 2 forces come into play. The first one being that everyone wants to buy the gold, but on the other hand, if they start liquidating the market and liquidating stocks, precious metals can get dragged down initially with them. So we'll have to see how this plays out. And I have to say, other than my usual physical holdings of gold and silver that I've held for about 13 years now, we don't have anything. I don't think you've got some silver. I know that, Dr. K, from all that silver that came into the office last year at good prices. I might add, but we're not dumping that right here, and but also not adding. I think if I saw the price of physical gold drop below 1,400, I might consider adding to physical holdings. In terms of stocks, I'll just tell you what I'm doing. The market's down, so I haven't been afraid of going after some things on the short side. And you guys know that last week I talked about Facebook is a short, and it's broken down. You might notice something here, this little tiny red line. Facebook has finally started trading over 200 days since it came public last May. And so it does find some support along the 200-day, but this isn't a long-term moving average. It hasn't been formed for a long time, so you don't really know how the stock acts along the 200-day moving average. My feeling is, yeah, you'll get a little bounce here, but you're not seeing much action here other than a reflex bounce. So it comes back up into this level, and I'm back on the short. I covered it down here up the 200-day, but it's coming back above 26. I'll hit it again there. I think stock, as I said, is headed lower. And you can see on this weekly chart here, you've got a little head and shoulders forming with your neckline straight across. And I think this thing's going below 20. So I'm trying to hold on to a longer term, or say intermediate term, core short position in the stock right now, with the idea that it is going lower. And I think Facebook, in terms of product announcements and whatever, is kind of out of bullets. And I'm not really, like I said last week, I'm not really impressed with Mark Zuckerberg. I think just a hoodie-wearing nerdy goofball who got lucky creating a silly Facebook page, but that's my view anyways. I know some of you agree with me, some of you might not, but for what it's worth, I think stock's going lower. I've been looking at Ocwen Financial and these mortgage stocks, and yes, someone has asked, are these shortable? I think the one thing to keep in mind here, this is a late stage failed base. If you look at the stock, it's had several bases on the way up, big base here, now it's failing. But the thing is, you're undercutting these prior two lows in the pattern, so you might see a rally back up to the 50-day moving average. If we get into a more bearish trend, and you see that occur in one of these stocks, the other one being NSM, which is blown apart. But notice it's also coming down to this low, and it's trying to hold. They're both trying to do that right now. I don't know if they're going to blow to the 200-day first, but if you want to try and short them, I keep a very tight stop on them. We can see the market's breaking down, heading back towards its lows right now. But yeah, those now become late-stage failed bases, and I think NSM is an example of a stock that we bought a few times. We bought the viable gap up, got stopped out. Bought the breakout here, got stopped out, and since then I've just stayed away from it because you get beaten up like that enough times, you don't want to go back unless you're a glutton for punishment. Michael Kors, I think retail is a place you don't want to be right now, and so Michael Kors, here's another one. We bought the Bible gap up. The stock looks like it's ready to take off. I get nice and big and fat in there, and in my own account, like I told you guys last week, I'll go in with 150% position right here if I think this thing is going to run, and then they smack me, and I'm gone very quickly. And you can see that in the stock market there are, in fact, two kinds of people, the quick and the dead. And in this case, I was quick, and we just bailed out of there as soon as possible. Now what you have going on here is if we look at a weekly chart, you have this breakout attempt, and now you're failing. So if you call this a flag down here, way back when it came public, that's your first stage, second stage, now a big third stage. Possibly it's a late stage base. All I know for sure is that it's a breakout failure and probably a base failure type of setup. The stock is trying to hold up today. It has been finding some support along these lows around, say, the low 55, high 54 area. But I think the stock, if it rallies into the 50-day, becomes a short, and I'm looking forward to break to the 200-day, which would be closer to 51, a little bit below there, as you can see on the chart. But that's another one I'm looking at. Lulu is one we had looked at before, and they announced that there's something wrong with. I actually had someone who is a VOSI member and actually a friend send me a pair of those at Christmas time, and I didn't notice that they were very sheer. They're kind of comfortable, but I have to say they're not. I don't like them as much as my hemp yoga pants, which are not really yoga pants but trading pants the way I wear them. But anyways, you can see the stock gap down and broke down here on pretty heavy volume 3 days ago, and you're rallying back up into the 66 level. I'd watch this because I think it becomes shortable as it rallies up into the 66 level, and I think that retail is not a place to be right now. Let's see a few other stocks. Santarus is one that we're still long, but it's actually acting well, and it seems to ignore what's going on with the market. Dr. K, you were saying this was actually a pocket pivot because you traded enough volume. If you discount this day 5 days ago, because you closed really at the peak of the range, the volume was exaggerated because of triple witching options expiration, and so we could count this as a continuation pocket pivot, and in fact the stock has gone higher. I would be surprised, if you're drawing a little channel here, maybe it moves to the lows of the channel in the high 16s on a pullback and see how that happens. But it wouldn't surprise me if it did that. We'd probably sit with the position and wait for it to really break down if that were the case before selling it. Some other things, LinkedIn, of course, is one that everybody's always asking about. I think LinkedIn needs some time to build a base. It's on the weekly chart. The ranges are tightening up a little bit in here, and it maybe needs to go sideways. If we go into a market correction, you want to watch and see how this one bases. But as far as I'm concerned, it's still a big leading stock, and on that basis, it deserves to be either in your portfolio if you own it a lot lower, or you're waiting to buy it on a proper pullback and a breakout, a new buy signal, which is actually what we're doing right now. So. Let's flip through a few more of these. Netflix, this is the thing about this market. If you're really going to make big money, you have to think way, way outside the box. And I guess buying this Bible gap up on Netflix, which is hard to do given the fact that if you look at the longer-term pattern, that's a difficult one to go after. But it has held up, and it's holding pretty tightly along this 20-day exponential line here and forming a flag. You know, I guess it's one to keep an eye on if it's able to shape up some kind of breakout. You know, other than that, I don't see a lot. You know, I was looking at the Semtech. This is another one. This had a viable gap up and went sideways. And Dr. K, this is your rule. You know, 1, 2, 3, 4, 5, 6, 7 days before you really come out of this. And would you have applied your rule in this case and just unloaded the stock, say, if you had bought it right around the 33 level?
Well, you know, it's got the low on that gap up day is 32.63. And
Yes.
after that point, it goes all the way down to 32.5.
Right.
So basically, yeah, that's just a hair. I usually give things an eighth,
Mm-hmm.
you know, an eighth room, and that would be an eighth actually, that right on an eighth, 12 and a half. Therefore, I probably would not have sold it. I probably, you know, there's the dime rule that IBD uses,
Right,
and
right. Which I think is arbitrary.
yeah, it's arbitrary, but it does. Well, I think they probably got that dime based on there's some near misses that they get, like that are less than a dime, and so that's probably where they came up with a dime. And if you give it 20 cents or 25, that's just too much. So
Right.
I assume that there's a rhyme and reason to it, like there's a rhyme and reason to my eighths.
Yes.
But then we don't do eighths anymore, so you know, eighths is 12 and a half. It would have been a tough call. It depends on market conditions on that day and a lot of other things. But it is pretty tight in there leading up to that undercut. So I'd be more prone to have hung on to it than sold it.
Okay. But that's another one I've been looking at. You know, the builders also were pretty strong, Lennar. But notice, see how it comes right back in, and it does tend to be a sloppy stock. I'm still not convinced that housing, the whole thing is for real, and I think a lot of it is manufactured by the fact that there is shadow inventory. Last week I mentioned looking at some of the work of Keith Giroux, who's a housing analyst on minionville.com. And Keith believes that there's a lot of shadow inventory out there that the banks aren't pushing through. So there's sort of a double-edged aspect to this in terms of the housing data, because number one, they view as positive the fact that there are fewer foreclosures, but really what that means, according to Keith, is that the banks are just not pushing foreclosures through, and instead they're holding properties on their books because they don't want to have to dump them, at which point they would have to value them at their true value, and they don't want to have to do that. So what that does is creates an artificial crimp in housing supply, and you're seeing the home builders in the short term take advantage of that. But you know, now you're hearing analysts say that they've got enough momentum now for 10 quarters going forward of great earnings and sales, and when all that starts to happen, I start to get just a little bit wary. But you know, that has been one area of strength. But you know, I would note also that when we're seeing this break down, this is housing related, and we've seen LL has held up. I keep an eye on all these housing related names, and the first ones, you know, of course, are the mortgage servicers. And this may be, when you see these start to crack one by one, this may be your clue that something is going wrong in housing, and you'll start to see the housing stocks break apart as well. So I think you want to keep an eye on all that and just watch how all the groups that are involved in that area act, and whether as one or more of them start to fall and break down, that's telling you that the weakness in this particular segment of the market is expanding. I think I'm going to run through some questions. I notice a lot of you say you feel the same way about Cyprus, and that everyone seems to be dismissing Cyprus. So I like the way you guys are thinking in a contrarian manner, and as I always like to say, think about what does the crowd know, and what the crowd knows is usually what is wrong. The market always seeks to fool the crowd, or at least as many people as it can. So what everybody knows, a lot of times the market can fool what everybody knows, or go in the opposite direction. I keep thinking, you know, they're poo-pooing this whole Cyprus thing, and you know, maybe it's the first domino to fall. Remember that the Archduke Ferdinand in, what was it, 1916 or in the 19 teens was assassinated, I believe, in Austria. Correct me if I'm wrong, Dr. K, since that's your area over there in Europe. But that was a small event that led to World War I, which was a very large event. So, you know, Europe has a tendency to get things going with small and silly events, and everything sort of gathers momentum from there. Let's look at a couple of stocks that people are asking about. AL was yesterday a pocket pivot. Technically, I would say yes. Confirm yes or no, Dr. K.
Let's see. I believe it was, yeah. That would
Somebody says,
qualify.
what rules or guidelines would you use to buy inverse funds here? Well, I'll buy, as you guys know, I'll buy the UVXY on a 620 signal using my little handy-dandy chart here, which you just got a buy signal just a little while ago, coming up through on the 5-minute chart right around $8, a little bit below. So I actually am long that. That's one way you can trade these, but these are day trades for the most part. Maybe you can hold them for a day or two, but for that we would employ Dr. K's crossbow model, which is a little more intermediate term. And we'll check on this. If we buy this on the basis of my 620 model and Dr. K's crossbow model is confirming, we may elect to hold the position for a longer period of time. Of course, the last signal on the UVXY created, or on the VIX, the buy signal created a 19% fail-safe loss, and so you got to watch out for that. But if you're using the short-term models, that tends to keep us out of trouble there, and at least we get to about break-even at worst. But you got to be careful. Now, as far as inverse ETFs, I suppose you could do. Let's bring this back. You could do what I'm doing with the SQQQ today, but I actually was picking this up yesterday near the close. You had a buy signal right at the close, and of course, Oracle blew up on earnings, and that sent the futures down pretty sharply. So that thing has been up and away ever since, and now you have another buy signal coming in here. That's one way to trade them short term. Whether you're going to make big money that way, I don't really know. I mean, I can hack away and chip away and maybe make some money here and there, but it's not that easy, and because these things are volatile in a very volatile news-oriented market, it's very difficult. Commvault, this is another stock that I hate because it breaks out here, and it just comes right back in, and it breaks out again here, and it just comes right back in, and it's breaking out again, big volume breakout. Back in 1999, if you saw a stock do this, it'd be up another 30 points over the next 5 days instead of pulling right back down into the breakout point. So I guess this comes into a viable range if you're in the mood to be buying it. So, I don't know. I don't like this stock because of its volatility. It's very, very tough to own. Somebody's asking, is STX okay against the 50-day here based on the pocket pivot of the 12th? Well, I don't know if I would. Dr. K, do you consider this a pocket pivot right here on Seagate? I'm not a buyer of Seagate, by the way. I'm actually looking at it as a potential sort of a pod setup, but I'm just watching this as it plays out.
I would look at it as a short setup, not
yeah, so we're not looking at
gap down on earnings, and that's a big flaw in the pattern, so I wouldn't be interested in this one.
Yeah, so, yeah, Dave. So, is FLT forming a pocket pivot today? Well, only if it holds up, I suppose. That probably would be considered a pocket pivot. There's only one issue here, and Dr. K, perhaps you can clarify this. It looks to me like you have a little bit of a V shape here, so it's coming off of this down and up sort of pattern, and that looks suspicious to me. Yes or no?
Well, let's see. It has to trade 2,095,600 shares to qualify, and so it remains to be seen if it really will do that. I mean, the pattern, it had a gap down on the 7th of March. So, but on the other hand, it had a gap up on good earnings, the most recent earnings report. So I would say, on balance, if the stock can get beyond that 2,095,600, then it would be a pocket pivot. And as far as the earnings and sales, those are looking great. Institutional sponsorship continues to grow every single quarter that they've been tracking. Well, since December 10th anyway, December 2010 rather. So yeah, it looks good if it can do it.
Somebody asked me a question in Gilco report. I think you mean Gilmo report, which is short for Gil Morales, I guess. That's never been my nickname. I forget who gave me that name and named the report Gilmo. So my nickname is G Money, but which is easy to spell, just a G and a dollar sign. And I actually have a guitar. I had a guitar made for me that has that in pearl on the fretboard. But in any case, somebody says in Gilmo report with Facebook, you refer to the 22-day EMA. Do we stick with 20-day SMA or what? Well, the reality is that they're really all the same. And I can demonstrate this. Let's do something here. Edit studies. Let's just do this here. And what am I doing here? No. let's do this just to get an eye. Let's use Facebook here. We'll put Facebook up. Okay, now you can see here I have a 20-day. This is actually a 20-day exponential, and I have a 22, a 20. It's a simple exponential. I kind of vary them on different charts, but what I noticed, they basically look the same. So there's not a lot of difference. And the green one is a 20-day exponential. Let's just go to, for example, a 20. Let's see. Hold on a second. Where are we? Moving average. Where did you go? Somebody help me out. There we are. Okay. Well, let's do a 20-day. So we have an exponential up there. Let's do a simple, and let's just color it purple. Whoop. Yeah, that's good enough. And so we'll type that in. And you notice here's the 20-day simple, and there's a 22-day, the 20-day exponential. They're running close together right now. There's a little variance here. And I think what happens is that, to me, the exponential moving averages are a little steadier and a little more reliable that way. But, you know, one or the other can work. You could run them both. You could run them all. You know, whatever you want to do. But I think they're sort of interchangeable. But I have to say that I found that either a 20 or 22-day exponential works best. So, and instead of a simple. And I got that from our friends Ian Woodward and Ron Brown from HCS Investor Software, where I'm going to be presenting at their conference, their annual conference in Paulus Verdes on Sunday, by the way. So, anyways, let's see. Another. What do you consider a distribution cluster in an index? I don't know. It's not anything that we've ever talked about. I guess a distribution cluster would be, you know, maybe 3 or more distribution days within, say, 2 weeks or less. I don't know. Somebody says, what do you have against hoodies? Not really anything. It's just some of the guys who wear them all the time. I have a hoodie, and I like to wear it on cold days, you know, around here, because you get the breeze coming in from the ocean, and, you know, it can hit the back of your neck. So I have nothing against hoodies, per se. We talked about LinkedIn. What about SWY, somebody asked. What about it? Breakout here, pulling back. Not a stock that I really like. The one thing to keep in mind here is, depending on what the market does, you could be in a late-stage situation. This could be something that breaks down. So I'm not really a buyer of this. Dr. K, any comments?
Yeah, no, this is not something I'm all that interested in. I mean, it keeps violating the 50-day. It's a sloppy pattern, and you know, it could redeem itself if it were to attempt a breakout on sound volume. You know, the earnings and sales are not the most impressive, but in terms of earnings, the institutional sponsorship has grown in many quarters. So it does have some quality aspects to it. The industry group, on the other hand, is very low ranked, so that I would take that into account.
Yeah.
But in general, it doesn't seem like it's not my favorite pattern if you're looking at this on a weekly. So it's a bit sloppy, and I'd probably avoid it.
Somebody says IBD calls Netflix a high tide flag. Well, it is, and so it's acting okay. So, but they're saying, could this be one of the examples of a climaxing at the end of the bull? Former leader, but leaders seldom return. That's a good point. And I think if you go back and you look at First Solar, it's had its moments, you know, where it tried to come back and you know, broke down here and tried to return as a leader, but that never happened. And it tried to do that again here. So, you know, a lot of ways I look at Netflix as being similar to First Solar on the breakdown, and then it formed a flag in here. I think Netflix has a better pattern right now. But, you know, as we talked about last week, or last week rather, it is a turnaround situation, and maybe it works, but I think you're going to have to see some stronger technical action. You had this sort of pocket pivot gap move right here 7 days ago actually, and it failed immediately. So, you know, it's a little suspect there. Do you think Celgene and Cerner have topped off and are setting up for a downturn now? Well, Celgene, we own Celgene, and it's basically paused to let the 10-day moving average catch up to the price. Now, maybe it pulls back and forms a base, but if you bought closer down in here, you're still okay. But on the other hand, you know, if you think it's going to break down and it makes you nervous and you lose sleep at night, then maybe you could take a profit, because it looks to me like what it will have to do now is have some sort of a pocket pivot or another buy point in here. So you just have to see how that pans out. But I can't tell you whether it's going to come down or not. Cerner I don't really care much for. Stock is up there, but you know, you're using the 50-day moving average as your selling guide, and the last few days you haven't seen a lot of heavy selling volume, but it has been a stock really that we've been following. Have you, Dr. K, do you have any views on this?
No, the CERN's been pretty slow, and yeah, certainly not something that really sparks my interest. Again, if you look at the weekly on this, it's pretty sloppy, and it's a slow name, and the relative strength is low. The earnings and sales are nothing to write home about, so it's not that interesting. All that said.
Right. Somebody asked if LinkedIn had a well, it hasn't really violated the 10-day because it closed below it here, but it hasn't moved below the low of that day. But as we talked about last week, we're not using the 10-day moving average as a stop. You're using the 50-day, and theoretically, the 50-day will catch up, so it's not so far down. Right now, that would keep you above the low of the Bible gap up day, but you have to decide what you're doing. My view is that it's okay to take some profits here because I can re-enter on another buy point and just wait rather than sitting here and watching it drop 10%, which it could easily do. Remember, leading stock can drop 11, 12% just as a matter of course during their uptrends. So my view is if it can't hold, you have this little flag here on the daily chart, it breaks out. If it can't hold up in tight and starts to come off, then I'm more inclined just to bag any profits and move along and wait for a new buy point. HLSS, this one I think is going to get into trouble because of the other mortgage servicers. And once you see one or two or three or four stocks, and they're all breaking down. You have this CoreLogics is one that's broken down. The other one was this ULTA Investment Management, which is really blown up. And I think HLSS can buck the trend, but when you start to see a number of stocks in a particular group start to break apart, the odds of the last one holding up coming off increase. And so if you have a profit there, I might be inclined to bag it and wait for a new buy point. Somebody asks, any sell signals in LL? Well, I don't really like the straight down and straight up to new highs. If you look at it on a weekly chart, you go one down and two up, and there you have heavy volume after a long run. So I'm a little wary of this, and frankly, if it were me, I would just take profits. Now, I don't say that with any certainty that it's not going to go higher or with any certainty that it's going to break from here. But given this kind of action, if I had a profit in the stock in this kind of market, I would be inclined to take that profit. Somebody asked, was that voice the old lady or your robotic trading assistant? Actually, my wife looks quite like a young lady and sounds like a young lady, but that old lady voice you heard was my briefing.com alerting me to a news item on a stock on my watch list. Anybody who uses briefing.com, you know that you can set audio alerts when there's a news headline coming across on a stock on your watch list. The old lady voice will come on. To me, it just sounds like Siri actually on my iPhone 4S, but that's what that is. So, Dr. K, UVXY has to be close to a buy. Can you comment, please?
Well, UVXY doesn't really have to do much of anything. In terms of actually buying the signal, the problem with the UVXY, well, really the issue is that it tends to have a bias to go down, not up, and to catch it right on the upside is quite tricky. So you have to see everything in a row before the UVXY is actually going to go on a buy signal. Let's just say that a number of buy signals are going to be non-profitable, but the one that hits is going to be wildly profitable. But that creates a lot of risk in the model, the way it works on the buy side. The sell side, on the other hand, more often than not, should work fairly well with less risk involved. So in terms of the UVXY going to a buy signal in this kind of environment, yes, it could happen, but it needs to see everything in a row before it's going to take that kind of risk on board. Yeah.
Would you hold a 1x inverse fund in your clients' accounts? Well, we do actually run managed accounts that are based on the market direction model, so yes, we do that. And sometimes we'll own 2 or 3x ETFs. Some more comments on Cyprus. I think I'll just read these for the benefit of the group here. The crowd thinks another European problem will be resolved with another Band-Aid. I like this one. Just when everyone is comfortable, that is when the whole machine comes unglued. It literally seems like nothing can pull this market down. Yeah, and when it starts to seem that way, that may be when it comes down, right? And I think that's the point you're making there. Remember when Bernanke said the financial crisis was contained to lower-end mortgages? This is why I do not believe Cyprus is nothing. I would tend to agree with that. Let's see. Save. People are asking that. This is Spirit Airlines. Oh, and my e-signal has decided to take a bathroom run, apparently. Let's see. Here we go. That's kind of, you know, I'd say this is climactic, but, you know, you're coming straight up the right side of this big cup. It's looking a little frothy there, so, you know, I don't know. If you bought it lower, you want to look a gift horse in the mouth, you know, maybe you could take profits, but how do you know it doesn't just go tight sideways at some point and go higher? So there's really nothing there to worry about unless it starts to break down. Dunkin' Donuts. Well, we know that Krispy Kreme has done pretty well, and even on a earnings miss, the thing was able to bounce back and close at a new daily closing high yesterday. Today we're coming off, but Dunkin' doesn't look so hot. I think it's the weaker one. And you see this big reversal here on volume. It's red because you open higher than you close, but not by much, and I think that looks kind of weak. On the weekly chart, it looks even weaker. This almost looks like a pod sort of formation. So I don't really like this this stock. Dr. K, here's one for you. What is your take on a number of the Direxion Funds 3X inverse ETFs doing a reverse 1-for-6 split on April 1st? The TZA is the one we use, and is this to keep more in the game for its price to be over $10 a share? Let's take a look at that.
Yeah, I mean, these leveraged ETFs will do reverse splits simply because there's a tendency for the price to go lower over time. And the reason simply also is because if you look at the general markets since March of 2009, the tendency has been for general markets to go higher. So a reverse split keeps these stocks in the game. You don't want to have a stock at $3 a share or $2 a share. You want to generally their aim is to keep these stocks priced anywhere in the double digits. So that accounts for the reverse split, and I believe that there's a number of other leverage ETFs that are also due to reverse split on that same day.
Somebody's asking what we think of Chewy. You got this flag breakout here. It's a very volatile, very thin stock. Myself, I don't really care much for it. I think what does it trade these days? Volume 30. What is that right? 32,495 shares. Is that right? Am I looking at this right? Wait a minute.
It trades on average. I'm getting 238,000.
What's going on here? Yeah, so it's thin. I mean, it's thin, volatile stock. It's holding the breakout so far, but I've never bought this stock because it's too thin. Somebody says Gil must be a Stevie Ray Vaughan fan too. Actually, I am, and I have to tell you guys, I went to see Stevie Ray Vaughan in 1983, I believe it was, or 82, 83, at the Kabuki Theater in downtown San Francisco. And back then, nobody really knew who Stevie Ray Vaughan was, but somebody told me, oh, you got to go see this guy. He's wild. He'll blow your socks off, blah, blah, blah. And I'm like, oh, yeah, sure. And so we went to see him play at the Kabuki, and everybody was sitting at tables, so that gives you an idea of what it was like. It wasn't, a throng of people crowded together doing slam dancing. And I actually got to see him. I was at the front table right in front of the stage, probably about 10 feet or less away from him. And he actually did blow my socks off. Had to go run to the back of the hall and find them. But yeah, that was an amazing experience. I never heard of this guy, and just watching him play that close just blew my mind. And yes, I am a big Stevie Ray Vaughan fan. And I'm sad that the guy, had an untimely death really at the prime of his career, because he really was an amazing guitarist. If you got to see him up close, I mean, he was just fluid. He just flew. I mean, there was no even. I think Eric Clapton even pointed out that he would say, if I'm doing a solo, I got to think about what I'm doing. This guy never thought about it; it just flowed from him. So he's probably a reincarnated blues player. So, but I got to tell you, one of the guys I like a lot right now is Joe Bonamassa. I think he's another talented guy. Do you believe the CVRR IPO base is sound? Well, I guess the best measure of soundness is whether it holds. So you get a little flag and it breaks out. But this is a thin little oil refining company, and they're going to have some big earnings this year. I guess 673 is what they're looking at, up 67%. 2014 though sees the estimates drop off to 422. And refining has become a big issue, particularly in California, because of the fact that we don't have much refining capacity, I guess, and so I don't know where these guys are located. Let's see, they're in Sugar Land, Texas. So if it worked, it's sound, and if it doesn't break down, it's sound. I think that's how you base it. You don't really have an opinion about it. Steve Jobs always wore blue jeans and a black turtleneck. I thought Steve dressed pretty nicely. I used to work at a company, Dialogue Information Services, that had a building where we leased out some office space to Steve Jobs' company Next Computer back in Palo Alto, and Steve used to come in about 10:30, 11 every day, driving a different car, and he really wouldn't give anybody the time of day, but smart guy. So I would prefer blue jeans and a black turtleneck over a hoodie any day of the week. Do you think Celgene and LinkedIn could be supported and make gains next week due to institutional window dressing? I think that's just an opinion, and I wouldn't speculate on that basis. WGO is what is WGO? Is this an oil stock?
Is that
no, Winnebago. What am I saying? I don't know. I guess everybody's going to have to move out of their house and move into RVs, but the stock has been surprisingly strong. Earnings were up 550% last quarter. Sales are accelerating, going 15, 24, 47% over the last 3 quarters. It's a razor-thin margin business, but they're executing, and you had a breakout, and right here, there's your breakout, and it's holding the breakout, so there's not too much to think of all of that. WDC is Western Digital. I think this is like STX, the old digital, the old disk drives rather. It's kind of old technology, and you see a breakout here, and you're failing. So you're also seeing this sort of straight down, moving straight up. So it has sort of pod-like features here, so don't really care much for it. CMG is at a short. It may be a short again, but here's your big breakdown, and so you got this complex, what I'd say a big head. This is your big head and shoulders type formation. We get the big head, and then all these little left shoulders, and then you got these right shoulders, and you could have made money just shorting it here. And you notice how you get above the 200-day here. It's possible this thing could break down, so you'd want to watch for that. I think if the market were to roll over, you'd see it go on another leg to the downside. You're not seeing a lot of buying interest in here. You see the lighter blue volume bars on the weekly chart. As you're pulling back in here, you're not really seeing any selling pickup either. So I think you need to see the thing break down, or you could try shorting here using the highs over here as your stop, which is maybe about, I'm going to say, what, about 3 or 4% higher. URI, United Rentals, this has been pretty good, but to me, this thing is looking a little wobbly here. I'm not a buyer, so if you own it, all you know for sure is that the 50-day is what it tends to obey, therefore you're using that as your selling guide. Goldman Sachs, I actually thought Goldman Sachs was looking okay the other day. It had a little pocket pivot, but it had already violated. I believe it followed the 10-day for at least 7 weeks here, and then it violated here. So that was a sell signal, but it was starting to negate that sell signal here with a pocket pivot. But of course, on Monday, the market came off because of the Cyprus news, and they hit the financials. And there's some very loud commentator out there, we know who he is, babbling about how there is no justice in the market because with the Cyprus banks in trouble, J.P. Morgan and should be up, to 60 or something like that. But I think he's missing the point here. For all you know, the market is telling you that these guys have some exposure to that area, and that may be why the thing is acting poorly. My view is if you had a pocket pivot, and this is the way I'll handle a pocket pivot, if a pocket pivot busts through the 10-day moving average, I'll use the low of that day as a quick stop, because in my view, they should at least hold up and go sideways, but if it immediately breaks down like that, I just think I'm gone, give it up, and just move along. So somebody asked, with the UVXY, what do you use as a sell signal? Well, the sell signal is a breakdown. We've talked about this pattern. This is what I do on an intraday basis, but not always. If you're in this thing lower and you want to give it another dime or so on the downside, you might sit through this, but it's really not. If you're not that sophisticated of a trader and you can't really understand this sort of chart very easily, I think I would just stay away from it and save yourself the grief. Away had, we didn't like this one last week, but as I like to say, what we don't like sometimes will go higher anyway. So what we think doesn't really matter, and I think the market can confirm that any number of times in the past. But you have a Bible gap up, and you're using the low of 31.37 as your stop, which is about 3-4% below where it's trading right now. So, the question is whether you're going to buy into something like this. You're in a low position here in the pattern. You're coming up into this area of potential resistance, so I think it's a riskier one to buy. Do you have any comments on that, Dr. K?
Yeah, what I like about Bible gap ups is they often reset the stock, and so we didn't like it last week, but today we like it because they got a deal, a very favorable deal with Travelodge, I believe, and also received an upgrade. So it changes the tone of the company in terms of their profit potential going forward, and that's expressed in the technical action we're seeing today.
Yeah, that is true. And I think, depending on what the market does, if the market starts to break down, though, would you want to be moving into this given its thinness?
Well, if the market starts, obviously, there's a rule of thumb that don't buy more than 1% of the average daily trade of a stock. That way you can pretty much flip in or flip out without moving the price too much. Unless you're really at a slow time in the day. But if you're at a slow time in the day, you can afford the time to work the order. So if the market were to come off and I were to buy it here, of course I would be using the low of the gap up day as my sell point. And maybe give it 1% porosity or something. So in other words, I know what my risk is in getting involved in a name like this.
Right. Somebody asked about NXPI, and I talked about this last week, actually. Well, there goes my e-signal again, blocking up. I don't know if it's this crummy PC or what, but this seems to happen a lot. You get this white screen and everything stops. I talked about this last week because the one thing, I actually bought some of this, right about in here. It looked like it was pretty tight on the weekly chart and getting some support off the lows. But then 3 weeks ago, these guys announced a 25 million share secondary offering, and at the beginning of February they had announced a 30 million share secondary offering. So to me, these guys are doing the same thing that the management of Michael Kors did, which basically they're going to bail out, and the shareholders or anybody buying the stock right now can be damned. And I don't really care much for that. So in my view, you had the gap down on secondary in a company that's unloading 30 million and then 25 million shares of stock in rapid succession. That tells me something isn't quite right. And if a lot of the selling shareholders are private equity companies that bought the company a while ago, they're probably smart investors, and they're probably bailing out for a reason and using a strong price move or uptrend in the stock to sell into. So once that happens, I'm gone. So if you own this one, I wouldn't be sitting around because it's now starting to violate the 50-day moving average. So I'm not really a fan. And I think actually you might be in a position where the 10-day moving average violation was enough to be selling it. But I don't really care for it. But I think the key, the crux of the matter here is the secondary, where they're dumping stock again, just like Michael Kors. Let's see. Zillow, I don't know about this. Straight down, straight up. I'm not a buyer here, and it's just kind of a thin, funky little stock. I don't really care much for it. Trades 354,000 shares a day. I'm not a buyer. Samsung announced their wristwatch product to compete with the Secret iWatch. Is INVN a supplier to Samsung? I believe they are. IBD had an article on them recently, I think, but I'm not a buyer of InventSense. You'd see, if there was anything good here, you'd see it in the price volume action, and it's just moving lower, so I'm not bothering with it. Somebody mentions that...
Actually, their largest customer is Samsung at, I think, 20%.
Right.
But the technical action is just absolutely abominable, so,
it's
don't
horrible,
touch it. 10-foot pole unless it can clear 15 on a good action up to that level.
Yeah. Somebody mentioned it's just getting back to the music thing. I mean, Dr. K and I are both musicians, so we always like these sort of conversations. But somebody says Stevie Ray Vaughan's brother, Jimmy Vaughn, is also great. Yeah, I've actually seen him when he played with the fabulous Thunderbirds. They opened up for Carlos Santana a long time ago, and he's a pretty good player. He's much more measured in his style, and I don't think he has that connection to the universal mind, at least the universal musical mind that Stevie Ray Vaughan did. He doesn't play anywhere near with anywhere near the same intensity. as I believe his younger brother. But I think Jimmy Vaughn taught Stevie how to play initially, and that's what inspired Stevie to play. But I think Stevie Ray Vaughan just had a connection to a higher source somewhere, and Jimmy
He's
Vaughn doesn't really
channeling the universal genius through him, through his fingers.
Exactly. Do you still not like Cree? Well, you have this Bible gap up here. I never said I didn't like it, but the earnings aren't all that exciting, and but it's acting okay. So I'd like to see it form another base in here, but there's nothing really wrong with it. I guess you could have bought this Bible gap up, and I think you get a little continuation pocket pivot move right here, and so it's holding up. So it acts okay. If you own it, I don't think you're in any trouble. Apple getting right for another short as approaches its 50 years of composure changing. Too many A's there. Let's back to. Well, first of all, one of my rules is if a stock is coming out of a range and has a pocket pivot volume signature and I'm short, I'm just going to cover and get out of the way. Now you see the 50-day moving average is coming down on top of the stock. It's going tight sideways. It's up today on a day when the market is down. So it's showing relative strength. So my thinking here is that I'm not going to come after it just yet. You can see on the weekly chart here, you can see that it's just starting to get above the 10-week moving average. And it may be that money looking for a safe place to hide comes into Apple, and of course everybody's expecting them to do something with their capital structure, either in the way of a dividend or whatever, I don't know, to bolster their share price, which I don't understand why they would want to do that or why they would have to. But it may be, Dave, I don't know. But I'm keeping an eye on it. SVR, Stevie Ray, not a stock. Yeah, if it was a stock, how would it be trading? Somebody asked me, what year did you graduate from Stanford? I think it was 1981, but it was all a fog, so I'm not really too clear. I have to check my diploma. Shutterstock, what is this? Well, why don't you tell me about this one at 28, 5 weeks ago? It's just running up, Is this a rocket stock, Dr. K?
No, not rocket stock has to go up quite a bit more than this, but
okay.
It's interesting.
Just checking. Okay, what else? Let's see. ULTA short. I've been looking at a few of these. I think ULTA, well, it's a little bit down there, but maybe it could be shorted if this is giving up, this shortable gap down sort of move. This is where you are in the pattern, so you're coming up to this low here, way back from April. So it's possible you could use like 82 as a stop. I'm sorry. Is that right? Let me see. Where are we? Yeah, maybe 80 as a stop if you wanted to come after it here, but it is weak. Somebody says, last week you and Dr. K referred to Away as a junkie stock, yet today we receive a BG report for Away. Well, that's because you interpret things in real time, and if there's evidence that contradicts what you thought a few days ago or a few weeks ago, what you thought a few days or a few weeks ago goes right out the window. And I think one of the greatest examples of that sort of thinking and being fluid and flexible in your approach to the market is the fact that I remember on it was around October 23rd, I think in my trading diary, when Bill O'Neill called me, October 23rd, 1999, and Bill O'Neill called me and he said, quite point blank, he said, this market is through. It's going lower, everything looks like crap, it's done. And of course, 4 days later, I believe on October 27th, 1999, we had a follow-through day and we were off to the races, and I went up over 1,000% in just about 2 months from that point. So I think the key is something looks junky, but if there is some confirming or newer evidence that looks to be strong, and there's also a news event for Away with the deal that Dr. K was talking about with the Travelodge, that changes the underlying conditions as well. So there's no, to me, there's no ego involved. There's no setting yourself up in a rigid position based on some sort of overarching opinion that you're sort of wedded to because your ego is wedded to an opinion one way or the other. You simply interpret the evidence as it comes, and if you thought something one day and the next day there's strong evidence that contradicts whatever you thought, it's right out the window, and it should be. And you should always be operating that way as far as we're concerned. Anyways, Alexion, someone asked, is that a short? I'm watching this thing, and of course you're sort of in a head and shoulders formation here, and here you are right up into this area of resistance here, overhead supply in the low 90s, and of course you're right at the 50-day moving average. It's possible this could be a short up here, and you're using your stop probably at the highs here at about 94 and change. I think 94.48 is the peak here. And but see, the way I would do this, if I wanted to short this today, the 50-day moving average is 92.65. My expectation is if the market breaks down, then this is going to move lower as well. So you could keep it really tight or a lot tighter by using either a 93.80 intraday high on today's action, or you could use a 50-day moving average at 92.65. Okay, let's see. Somebody asked, what's the name of the blues artist he mentioned? Joe Bonamassa. And B-O-N-A, I think it's B-O-N-A-M-A-S-S-A. So I remember first seeing him when he was 12 years old, and he could play pretty well for a 12-year-old. Now the guy's, I think, in his early 30s, and he just is very impressive. What would you recommend to a newer investor to do every day as part of a routine to become a better trader? I don't know, everything we talk about, I think. Studying charts. So, somebody saying, what did you say about a year of big loss Juan experienced? I'm not sure what that means. I was talking about how Bill thought the market was in trouble on October 23rd, 1999, and then he immediately changed his opinion 4 days later when we had a big follow-through day, and a lot of leaders like AOL, for example, broke out. Not AOL, but Qualcomm. And what were some of the other ones? I think Schwab, no, Oracle was another one. Sun. There were a bunch of them that broke out, and he changed his opinion. That's what we were talking about.
Yeah, of course, the bellwether. I mean, the other network, internet-related stocks that were soaring.
Right, and you know, that's what Bill was really a master of. I mean, he might think something one day, but he had no reservations about changing his mind once he saw the evidence turn to the contrary. And I think that's what makes him such a great trader. And I think a lot of people who went to work for Bill on the institutional side got really hung up on the fact that he made a lot of mistakes. And he would, like anybody else, you know, as we say, you can be right. You only have to be right 1 out of 3 times to make a fortune, and so he would be right once and be wrong twice, but he'd get out very quickly when he was wrong, and he would load it up and really know how to work a position on the long side, or you know, once you got the market going and he saw something to the contrary that he could capitalize on, he would just shift so quickly. It was an amazing thing to watch, and that was definitely one of the great lessons of working with him. Ruckus Wireless, I don't care for this. Straight down, straight up on the weekly chart. Almost looks a little bit pod-like to me. And I don't care for the numbers on the stock. I don't think they're happening anymore. 14% earnings growth, not very. You see the market's blowing apart pretty nicely here. Last question. It is 11:06. Kenny Wayne Shepherd also reminds me of Stevie Ray Vaughan. Really wails that act. Yeah, he's another one. And there are a lot of guys who followed in his footsteps. But anyways, I think we covered everything for everybody. I gave you a couple of shorts. Maybe you guys were able to hit the course earlier when it was up, and you can see it's starting to break apart. You can see Facebook is starting to head back down for the 200-day. We'll see if it gets through at 25.44, I believe is where that is at. And we talked about some other shorts. And that's pretty much it. But, you know, like we were talking about at the outset of this webinar, and a number of you agreed that there's a little bit too much complacency about this Cyprus thing, and I think it may be more than anybody really wants to believe it is, and that's going to be a problem for the markets. But we'll see how it plays out. Dr. K, any final comments now that you see, we can see that the market's breaking down hard? Are you looking at a potential change in signal for the MDM or anything of that nature?
Well, of course, the MDM continues to monitor the situation real time. As far as Cyprus, it's still too early to say. I mean, you know, when these crises happen, you sometimes do get a market that sells off for a few days, but it does find its footing. At least it has done so in every case since 2009, as represented by the charts. And I'm not talking about a flash crash situation, but more about these dominoes that are, you know, being rocked back and forth. And the market inevitably will find its footing. And so until proven otherwise, you know, if the market wants to head lower, you know, another 2-3%, or maybe we'll see the S&P head toward the 50-day and then get traction. I would imagine that something would be worked out in terms of a deal in Cyprus, because no one wants to see Cyprus fall because of what it symbolizes.
Right. So we'll see how things go, and you know, you can see what's happening right now. We've got some ideas in terms of shorts, and Not a lot that we think is exciting on the long side, but we'll just have to see how things pan out. So we'll catch you guys next week. Just watch for our alerts coming in real time off of the website, and we'll just see how this pans out. So everyone, thanks for showing up, and we'll catch you guys next time. Take care. Happy
So long,
trading.
everyone.